Good evening, and thank you for joining us tonight. This is Midwest Energy. I'm Mike Morley, the Director of Corporate Communications and Government Affairs. This evening, we're going to be discussing Winter Storm Uri, the cost impacts of the February winter storm on bills, and also how Midwest Energy plans on recovering some of those excess charges. Also tonight, we're going to be discussing a proposed gas delivery rate change that will be approaching the Board of Directors with for a vote in May. Presenting tonight from Midwest, we have Pat Park, our Chief Executive Officer, Bill Dowling, Vice President of Engineering and Energy Supply, Tom Mice, our Chief Financial Officer, Bob Muirhead, Vice President for Customer Service, Fred Taylor, Vice President of Operations, and myself, Mike Morley. Because of the nature of the pandemic, we're having to live stream tonight using the YouTube format. So there's not a chat function to where you could ask questions during the presentation on YouTube. However, you may email questions to the following address. That address is questions@mwenergy.com. We are monitoring that mailbox, so if at any time during the presentation you have questions regarding either the Winter Storm Uri recovery or the proposed gas rate changes, please submit those, and we will read those and answer those on the air during the stream tonight. The first part of this evening's program deals again with Winter Storm Uri. Pat Park, our CEO, is going to give an overview, the big picture of what caused that event. Bill Dowling is going to look at both the electric and gas impacts, gas purchasing and storage, as well as the cost impacts. Pat's then going to come back and talk about the recommended gas recovery plan. Tom Mice will give an overview of the financial impacts on Midwest Energy. And lastly, Bob Muirhead is going to cover transportation customer matters. Those are customers that purchase their gas from a third-party marketer, then Midwest Energy transports that gas or delivers it to them. Then we'll take a break and we'll answer any questions folks may have at that time regarding Winter Storm Uri. So with that, I'll hand it over to Pat Park, our CEO.
Okay, thank you, Mike, and welcome this evening. So what brought us here? Of course, it's the cold weather event that we experienced in mid-February. Two things happened. First was a very high demand for natural gas because of the cold temperatures and the increased heating loads. And at the same time, electric generation was burning a very large amount of natural gas for fuel. So the combination of those two resulted in a high demand for natural gas. At the same time, the cold weather restricted the supply of natural gas. We had some freeze-offs of natural gas production wells in southwest Kansas and other states in the producing areas, and we heard reports of some gathering systems freezing off from the contaminants that were in the raw gas. Combined with that was problems at some of the gas processing plants. So in a commodity market, when we have a very high demand for the commodity and low supply, you end up with high prices. And this is not unique to Midwest Energy. Gas and electric utilities across Kansas and several states in the middle of the U.S. experience the same thing. Many investigations have been begun by the Kansas Attorney General, the Kansas Corporation Commission, the Federal Energy Regulatory Commission about what happened here, so we will learn more as we go down the road. Just one caveat before I turn it over to Bill Dowling, and that is the information you are seeing tonight is updated from what is printed on the Current Comments newsletter that will be included in April bills. The deadline for printing of Current Comments was mid-March. We are 3 weeks past that deadline now. We have more information, better understanding of the numbers, so some of what you hear this evening will be different from what's on the printed edition of Current Comments. With that now, I will turn it over to Bill Dowling.
Okay, thank you, Pat. So we'll talk first about the electric system impacts, but to tee up that conversation, we thought it might be helpful just to give you a little background on how we purchase energy and what impact our own generation has on those purchases. Midwest is part of an electric market that covers 14 states. If you look at the map of the U.S. up there in the upper right-hand corner of your screen, you'll notice right in the heartland of the company, the Great Plains, a red area denoted as SPP, which is Southwest Power Pool. And that's the 14 states that are included, all or in part, in this electric energy market. Within that market, all the generation that's available is sold into the market, and all the load buys the energy it needs from that market. When the generation is bid in, then the market operates to stack all those bids from lowest cost to highest, and those bids are built on variable cost. And chief among those variable costs is fuel, which could be natural gas, coal, wind, various other fuels. So those generators are then committed one day in advance, which then allows utilities like Midwest Energy that has generation that's based on natural gas, for example, to schedule fuel to power that generation. So we do that in two parts. We schedule a small, constant amount ahead of the beginning of the month based solely on what we anticipate we might run, but we don't know until one day in advance whether we're going to run that generation or not. So to actually meet those generation needs, then we submit daily schedules to the interstate pipelines, and those schedules are intended to match that day-ahead commitment, but then we're buying that gas at daily prices. So within that market, and this goes to what we're going to talk about next, the generators that sell energy into the regional energy market are kept whole. In other words, they recover their variable costs, including fuel. You do not have to generate in this market at a loss. So with that, let's go to the next slide, and let's talk a little more about the impact that Midwest Energy saw. And the bottom line is, right now, we're not expecting that impact to be substantial. Now, it is based on preliminary market settlements, and it can and likely will change somewhat in the coming months, but we are not expecting the impact on our operations to be significant, at least from a cost standpoint. And so here's a couple things we can show you to demonstrate that. This is 3 different time periods, the amount of energy we had to buy and or generate, and the average cost of that energy. So first, if you look at February of 2020, the same month in the prior year, you see there about 137 million kilowatt hours were required to serve our load, and the average cost of that energy was about 4.2 cents per kilowatt hour. If you roll forward then to January of 21, the middle row on that table, you see that the volumes were slightly higher, the cost was somewhat lower, and so the average cost per kilowatt hour was about 3.8 cents. For February of 21, the month in which we endured the polar vortex, the volume for the entire month was actually down somewhat, but the cost was up. For us, it was not a large price increase. It averaged out over the course of the month at about 4.6 cents per kilowatt hour. Now, there were certainly days during that polar vortex event, roughly from February 13th through the 18th, that the prices were much higher than that. But so far, the electric bills are largely unaffected by those February events. If you saw any effect at all, it was more likely related to consumption than the cost of the energy. So the bills in the second quarter of this year may see a small impact that's going to include some February effect as well as regular quarterly variations in the price of energy. But again, we don't expect that to be a significant impact. Now, as I mentioned earlier, we do have some of the initial market settlement data, but it's likely going to be several months before that complete cost picture is clear. And as Pat mentioned earlier, there are some ongoing investigations at the federal and state levels associated with energy pricing, and it's going to take some time for all of that to work its way through the process. So let's go on then. Let's talk a little bit about purchasing gas and what happened on that side of the ledger. Again, we're going to start first, though, by talking about how we purchase gas. And in this case, we are not part of a multi-state market, but rather we purchase our own gas supplies through an annual process where we issue a request for proposals to a number of different suppliers and ask them to come back and make an offer to us to sell us gas. Within those requests, we ask for two types of prices. We want to get prices for a first-of-month nomination. In other words, a volume that we would hold flat throughout the course of the month. And you can think of this as meeting our minimum load expectations for each particular month. And then the pricing for that first-of-month gas is going to be tied to a published first-of-month index, and that pricing will stay flat for that volume of gas throughout that month. On top of that, then, we seek proposals for daily volumes, which we can nominate one day in advance and in some cases during a particular day to change our volumes to match expected load. In that case, the prices that are normally going to be associated with that are going to be daily prices that are available through a series of published indexes. So once we get approaching the beginning of each month, we will then make that nomination based on the award of bids to a particular supplier for that first of month volume, and we base that volume on long-term weather forecasts and on historical volumes and some other information. Then during the course of the month, we'll add on top of that, as needed, some daily schedules to match the expected daily volumes, and that again is going to be based on weather forecasts, but nearer term forecasts. And we'll also look at history with similar weather. So let's go to the next slide. The other thing that we can do with that is we can supplement those schedules with storage. We purchase storage capacity on some interstate pipelines, and that's just a reservation of space to store that gas. Then, when actual load conditions indicate that the load might exceed the amount of gas we've scheduled a day in advance or for the month, then we can nominate additional volumes to come out of storage to cover that shortfall. However, there is a limit on how much gas can be withdrawn from storage in any 24-hour day, so we have to be aware of that limit as we're scheduling all of our gas supplies. On the flip side, there are other times when the load may turn out to be less than what we scheduled, less than we anticipated. And so in those cases, we'll move the excess, the leftover gas, into storage and save it for later use. Here again, though, there is a limit on how much can be injected into storage in any 24-hour period. And so scheduling gas is a bit of a tightrope exercise, and that's not unique to Midwest Energy. Any gas distribution company is going to face those same challenges, and it's a very common practice. So let's advance to the next slide and talk a little bit about the impacts that we actually saw during February of this year. And again, we'll start off just as a point of reference to give you some perspective on some prior periods that we looked at. So in February of 2020, you can see that the volume we served was about 5.4 million therms, therms being the unit of measure that you see on your gas bill. And the average commodity cost of that gas was about 16 cents per therm. But I'll also draw your attention over to the right-hand column, because our heating load is very weather sensitive, obviously. And so there's a measure we use to compare one time period to the next called heating degree days. And you can see that in February of 20, we had 911 heating degree days. And that's a function of the minimum and maximum temperatures on each day of the month. Looking forward then to January of 2021, the consumption was up somewhat. January of 21 was a colder month, and you can see that in the heating degree days. And the price of gas was up, and that's largely a function of supply and demand. It was at about 24 cents per therm. But then the polar vortex came along in the middle of February. You can see that our volume was up a little more in February of 21. In fact, it was about 22% higher in February than it was in January. But the cost of the gas was substantially higher. Just on an average over the course of the month, rather than being 24 cents per therm, it was about $1.68. That's 7 times higher. And if you look at the total dollars we had to spend during that month, it was at $12.5 million compared to about $1.5 million in January of 2021. So that was about 8.5 times higher. Now, some of that you can expect based on the fact that it was a colder month, but gas was very expensive. So if you look at the total amount that we spent for natural gas in February, again, about $12.5 million, we needed to be able to send out bills starting in early March, and so we put a little bit of that cost on the March invoices to ease us into that recovery, although we were anticipating that we would recover the bulk of those dollars over an extended period of time. So we recovered about $2.5 million of that $12.5 million during March, and that's about 20%. But that leaves about $10 million yet to be recovered. So we'll call this our excess gas cost, and we wanted to look at ways to amortize that. We looked at a number of different scenarios for how we might do that, but ultimately recommended to our board the recovery of that $10 million over a 24-month period. If we do that, and if the board ultimately approves that, that's going to add about 14 cents per therm to each month's current gas cost. And that's going to start no earlier than July 1 of this year. For an average customer of any type, that amounts to about $261 per customer over the entire 24-month period. Now, the impacts on different types of customers are going to be different. And with that, I'll hand it back to Pat to start talking a little bit more about what we're recommending we do with this amortization.
Okay, thank you, Bill. So in summary, what we staff is recommending to our board is that we target a 2-year amortization of the excess costs. And we deliberately use the word target there because actually what we're specifically asking for approval on is the ability to add 14.3 cents per therm to the remaining gas costs, and then we will recover that until the 10 million is fully recovered. Given the average consumption of natural gas, we expect that will take 2 years. For an average residential customer, that's $8.27 a month, a little bit lower in the summer and higher in the winter because costs are higher. So if you do the math on that, $8.27 times 24 months, you get real close to $200. That's for an average residential customer. Bill mentioned that the average for all classes of customers was about $261. We're also recommending to the board that the irrigation class be excluded from recovery of these costs because almost certainly they were not operating during February. Even in what you would consider a normal February, the amount of gas sold to irrigation customers is very low. And this year, during this event, with those extremely cold temperatures, they certainly would not have been watering and risking damage to their equipment. So again, we're recommending the board exclude irrigation. Now, just as Bill mentioned on the electric side, we do not have 100% certainty on the final costs on the gas side. The biggest outstanding question is the waiver that one of the pipeline companies has requested to not charge overrun penalties, which is of benefit to Midwest Energy. That has been filed at the Federal Energy Regulatory Commission and is pending their consideration. So again, we're expecting that the FERC will allow that waiver, but until that actually happens, we can't say for sure. And again, a reminder that the information you are seeing here is an updated version of what's printed in current comments. We are putting updated information on our website for you to refer to later. So at this point, I'm going to turn the discussion over to Tom Mice, our CFO, to discuss the impact on Midwest Energy.
Yes, thanks, Pat. So this is Tom Mice, CFO at Midwest Energy. As Bill mentioned earlier, we have about $10 million in excess gas costs during that storm, Uri, that we need to recover from customers. As you know, we would have already paid our suppliers, so that cash has went out of Midwest Energy, and so we need to determine how we recover that amount back. In making that decision and determining how long a period we can cover, one of the things we need to take into account is the impact on Midwest Energy's financial strength. An important measurement of financial strength is our equity as a percent of assets. And so we've included a chart here for you to look at. And we've got 4 years of history in there, and then we show about 10 years forecasted. And there's two lines on this graph, and if you look at the blue line, what that represents is our combined company equity. And as you may know, Midwest Energy is a combination of electric distribution, electric generation and transmission, and gas distribution. So that blue line includes our equity as a percent of assets for the entire company. But when we're trying to make a decision on this gas amortization as it pertains to our gas division, we need to look at the equity related to our gas division. And the reason for that is each of our divisions have different equity requirements based on the amount of capital that the division uses and also the risk profile. So as you can see in the orange line, that represents our gas equity as a percent of assets. And we target around 45%. So you can see going out into the forecast that when we amortize, when we incur this $10 million, in 2021, we expect that we're going to end the year just a little above 40%. So we definitely take a drop in our equity percentage because we're having to finance that $10 million mostly with debt. But then as we amortize and collect that from our customers over hopefully around 24 months, then we start to recoup that. But it never fully recoups, and you can see that dotted line still hovers a little bit below the bolded line there. And that's because we're not charging our customers the interest cost or the time value of money for that $10 million fund. So that the company does take a minor hit for that, but really not bad. Not, in a few years we'll mostly recover our equity. So basically from this graph, we can see that Midwest Energy's plans here, and we've got a strong balance sheet to be able to amortize this over that period of time and still maintain our financial strength. Another very important financial measure that we look at is our average gas rates. And so I've got a graph up here that shows our average annual retail gas rates. So this does not include our transport. Bob will be talking about that in the next slide. These are our retail gas rates, and I need to explain this includes the cost of our of gas, the commodity, and also our delivery charge. So it's the total revenue that we get from our customers divided over the amount of therms that they consume. And you'll see that we've included about 15 years of history here, and the average gas rate is very volatile over that 15-year period. And Almost all of that volatility is tied to the cost of the commodity. The gas commodity price jumps up and down quite a bit, and in the past has been much, much higher. All customers of Midwest Energy and across the United States have enjoyed very low gas prices as a result of the shale gas finds, which really improved supply and brought prices down. If you look from 2021 on, those are forecasted average rates, and the gas cost commodity part of that, we are basing that, we don't project our own gas prices, we just use the various references out there that are available to us, including the Department of Energy. And so we utilize their forecasts, and then we, of course, put our delivery revenue forecast in there as well. So you'll see that for our main three customer classes, residential, commercial, and irrigation, that going forward we do project that the average rate will climb, and most of that is due to the forecast for the cost of the gas commodity. And again, on this graph, we have dashed lines here that show the impact of charging the amortization. And this impacts our residential and commercial customers. As Pat had said earlier, this will not impact irrigation customers. So for, and both on the residential and commercial represents about 14.3 cents per therm. So that's the increase that we'll have temporarily. And you'll see that for both commercial and residential, it peaks out in about 2022. And the reason for that is that, remember, this is an average annual gas rate, and we're hoping to kick it off July 1st of 2021, which means we're only going to have about a half-year impact of this amortization in 2021. Then we'll have a full year in 2022, and then another half year in 2023. So that's why this graph shows that it peaks out in 2022. So it does, for residential, it does take us a little above $1 a therm. But if you look back in history here, if you go back to about 2011, we were just about at $1 a therm back then. And then you go a few years prior to that, we were much higher. And if I would have took the graph back even further, you could have seen even higher gas prices. So we're not, even with the amortization, is not unprecedented. On the commercial side, it takes it just a little above 80 cents. And we can look more recently to about 2014 is when our average commercial rates were above that level. So that gives you an idea of the overall impact to the average rate on an annual basis. Thank you. And now I'll introduce Bob, who's going to talk about transportation.
I'm going to discuss the issues that face our transportation customers. In the 1990s, the natural gas industry went through a deregulation process. One of the outcomes allowed non-residential customers to purchase their gas commodity from third-party marketers. Today, we have around 3,000 Midwest Energy customers that purchase their gas commodity from marketers. Roughly 2,000 are irrigation customers, and 1,000 are commercial accounts or institutions like churches, hospitals, and schools. Customers that purchase their gas from marketing firms are called transportation customers. Midwest Energy delivers the gas to these customers through our pipes and meters. Midwest Energy's natural gas bills include third-party marketers' commodity costs for most of the customers that are transportation customers. The marketers tell us the price to bill for the commodity monthly. The Midwest Energy bills include third-party marketers' costs and Midwest Energy's delivery and customer charge. Midwest Energy collects the payments and forwards the marketers' portions to them. Next slide, please. Transportation payment arrangements. As noted earlier, Midwest Energy has proposed spreading out the cost from Winter Storm Uri over 24 months. The bills that marketers have presented, they have decided to include the entire costs from Uri in one lump sum for most transport customers. Some very large gas bills were sent to transportation customers. Any pay arrangements are between the participating customers and the third-party marketers. Many transportation customers have paid these bills in full. Marketing companies have worked with the customers. Midwest Energy is aware of 6-month and 24-month payment arrangements that have been made. The extended payment plans can cause difficulty with the Midwest Energy budget billing and automatic draft plans if these same customers are using those plans. There will be billing adjustments on bills where customers entered payment plans until the payment plan is completed. That concludes the information on transport customer issues. I will turn the presentation over to Mr. Morley.
Thank you, Bob. Okay, just a reminder to folks that are watching us on the live stream, the method with which you can ask questions to be answered tonight is to simply send us an email. The email address we'd like you to use is questions@mwenergy.com. And we do have a couple questions to go through, so I will go ahead and ask those now. And folks, if anybody has anything else, please get those in now as well. The first question, I'm going to ask this of Bill Dowling. And this question comes from a gentleman by the name of Ken. Ken's question is, what is Midwest Energy doing to isolate the root causes for the price increases in the month of February? Bill?
So thank you for the question, Ken. And there's a two-part answer to that. Obviously, the bills that we get from our various gas suppliers and from interstate pipeline companies, we always go through those and we verify those as best we can, particularly with respect to the commodity. We want to make sure that they're not only billing us for the correct amount of gas, but that they're billing it at the pricing terms that we have in our contract with them. So that part has already been largely completed. We've got those bills and have already paid most of those bills. Pat did mention earlier that there is one outstanding charge that has not been included in the prices that you see that we're talking about tonight relative to amortizing that excessive cost over 24 months. And that pertains to some overrun charges from one of the interstate pipelines. When the extremely cold weather hit and we had difficulty getting adequate supply, in some cases we moved more gas than we had actually nominated for supply for a particular day. And so by terms of our contract, overrun charges could apply. That hit many utilities and delivery companies that are doing business on these interstate pipelines. And so we had some frank conversations with them about, are you sure you want to charge that penalty? At the end of the day, that particular pipeline company said, we think there's a reason not to charge that penalty. So they have applied to the Federal Energy Regulatory Commission to waive that penalty. We'll see how that turns out. So those are the kinds of things that we do to make sure that we understand what happened. And in this case, as far as we know right now, it was largely a supply and demand function. Now, one thing that we're not well equipped to do is to really investigate the root causes of the severe price spikes. And in fact, Pat, if you would, you might bring back one of the earlier slides that I had up there. It's slide number 5. And I didn't talk much about it at the time, but in the lower right corner of that slide, there's a chart showing what happened to the price of gas during this period of time. And it's a small chart, but as you can hopefully tell, the price of gas in February started the first of the month at about $2.50 per decatherm. That's about 25 cents per therm, like you would see on your bill at home. However, in the middle of the month, you see that the price ran up substantially. And these are prices on 3 different interstate pipelines that we do a lot of business on. And the highest pipeline in this particular case on February 17th saw the price of gas spike to $622 per decatherm, or $62 per therm. That's a dramatic increase, a factor of about 248 times that price increased on that particular day. And that had a substantial impact. As I mentioned a minute ago, we don't really have the ability to, or the resources to investigate this thoroughly, but other entities do. So that would include the Kansas Corporation Commission, the Federal Energy Regulatory Commission, attorneys general in both Kansas and some other states as well. And one thing they can do that we can't do is they can actually subpoena or formally request that suppliers and producers and gas processors turn over records of the transactions that happened on those days, the volumes that flowed, etc. So some of that is beyond our immediate scope, but we will certainly be watching those processes as they unfold.
Thank you, Bill. The next question came in via text, actually, somehow. The question is this: do customers have the option to pay their total amortized amount in a lump sum instead of over the 24-month period? We'll direct that question to Bob Muirhead, Vice President of Customer Service.
Thanks, Michael. As Tom had alluded to in his slide, we are going to use the money that we're receiving and not charge any interest on the bills that are owed that the customers will be sending us during this 2-year period. So there won't be an interest charge in that part of the payment. And so we are not offering a lump sum. It's just going to be a flat cost payback. And so we are saving the customers interest on that. So we will not be offering the option of a lump sum.
Thank you, Bob. We had another question come in via email. This one is from Lucas, and I'll address this question to Pat Park, our CEO. Lucas asks, did you consider figuring the recovery charges on a per customer basis rather than just raising the therm rate for everyone going forward? It seems like customers who worked hard to scale back their usage during the storm event aren't really going to see the benefit from that other than the savings on their March bill. So Pat, why did Midwest Energy choose to recover costs in the method being proposed?
Well, a couple of reasons, Mike. One is that we don't have any, we don't have any tariffs in place that allow for daily pricing to customers. And then a second reason, which is more of a technical matter, we do have automated metering in place, and we get regular meter readings from the meters. There's a term called a register read, which is what is used for billing purposes, and we get one of those every day. We do get more, some other readings, but the one we use for billing is called a register read. That comes in at midnight. When Bill was talking about buying gas, the gas day begins at 9 a.m. So there's a difference in synchronization of when that happened. And with the daily prices changing so dramatically, as Bill just illustrated on that graph, even if we tried to bill it on a daily basis, we would have some disconnection there. So we just thought it would be better to look at the entire month.
Excellent. Thank you, Pat. Okay, just a reminder to folks that are joining us tonight, if you do have questions at any point during the live stream tonight, please email those as soon as they come to mind. email those to us at questions@mwenergy.com, and we'll do our best to answer those during the live stream this evening. Okay, moving on to the second part of our stream tonight, we're going to discuss the gas delivery rate case that's being proposed. Again, Pat Park, our CEO, is going to give an overview of that rate case and its objectives and goals. Tom Mice is going to take a look at the revenue requirements, how much money that will raise for Midwest Energy. Bob Muirhead will take a look at the proposed rates and impacts to individual bills. He'll also talk about something called the formula rate, which will be a way of calculating bills going forward. Fred Taylor is going to cover a few of the things that we've done here at Midwest with regards to cost management, ways that we've changed our business practices to help keep rates as low as possible. And then finally, one last round of questions, either on the gas rate changes or on Winter Storm Uri matters. Okay, so we'll start off with Pat.
Okay, thanks, Mike. Again, just a high-level view of the natural gas delivery rate changes. We last changed our base rates effective October of 2016. Originally, we planned to make another change last July with a decision being made in April of last year. However, when the pandemic hit, we quickly suspended consideration of that. So what you're seeing tonight actually was proposed for a year ago. The objective here is to raise an additional $1.04 million per year compared to our current rates, and this goes to the delivery revenue needed to operate the company, not the cost of commodity that we've been talking about on the Winter Storm Uri. Even if the board approves this as proposed, our delivery rates would remain the lowest in the state of Kansas for both the residential and commercial rate classes. And just to give a little, perspective on the sizes that we're talking about of change here, going back to the first half discussion this evening, if we do a 24-month amortization of the excess gas costs due to Uri, the impact is about $8.27 per month for a residential customer, and the delivery charge rate change we're talking about is just short of $1 per month per residential customer. When we take on the work to do a rate case, we always set some objectives before we start that work, and two of the bigger items are the first bullet points on this list here, things that we want to do beyond simply recovering the revenue required to operate the company. One of those is to expand the use of a formula rate to cover our delivery costs versus our current system that is a combination of formulas directed to a couple specific costs plus an occasional rate case every few years. Second item we want to do is combine the gas supply costs for three different systems, as we call them. These are different portions of our gas facilities that have either been with Midwest Energy a long time or were acquired in business transactions over the years. Our practice on the electric side of the business, when we acquire additional electric territory, we operate that territory a while on a standalone basis in terms of electric supply costs, but we eventually blend that together. So what we're proposing on the gas side to blend the K, M, and T system costs would be similar to that. Also, every time we do a rate case, we perform a cost of service study, and so there are some adjustments being made to customer charges and the per therm delivery rates to more closely align our costs with the revenue recovery. We have one very small rate class, oil field. These are oil field customers who are using natural gas to operate their pump jacks. We only have about 50 of those left, so administratively it doesn't make much sense to leave them as a separate rate class, so we're proposing to merge that with our commercial rate class. The second to the last bullet point here addresses the fact that in early March we had a special board meeting We didn't know the total impact of the winter storm on our customers. And so for a short period of time, we wanted to make sure we didn't have customers jumping back and forth between regular sales service, as we call it, and the transportation service that Bob talked about a little while ago. Since we are proposing to not include the irrigation class in the cost recovery of the excess charges, we are proposing that we again allow migration of customers in that class between sales and transportation service. And finally, once we change our rates here, the objective again on a revenue side is to raise or collect an additional $1 million a year. And that's actually always the first step in a rate case, is doing what's called a revenue requirement. So we'll go back to our CFO, Tom Mice, to give you an explanation of how we arrive at the revenue requirement.
Yeah, thanks, Pat. So as Pat mentioned, it's been over 4 years since we've done a full delivery rate increase. Yet our expenses are the costs of owning and operating our gas plant for our customers continues to increase, and so we're looking at an increase to our delivery rate that amounts to about $1 million a year. So I wanted to kind of walk through how we arrive at that $1 million. So the first line of there is the rate base, which think of that as plant or assets, which is mostly the plant that serves our customers. So this would be like the pipelines, the meters, regulators, other plant, and including equipment that our employees use to do their jobs, such as trucks, power-operated equipment, computers, and even the buildings that like the warehouses and offices that we use to serve our customers. So all of that's included in rate base. Then we need to earn a rate of return, what we call our cost of capital, of 5.52%. And I'm going to come back and talk about what that is, or how we come up with that 5.52%. That'll be on the next slide. But that amounts to, every year we need about $4.2 million of what we call operating margins, and that's utilized to pay capital credits back to our customers and to pay interest to our banks and to maintain our balance sheet. Now the next line down there, expenses, $42.3 million. So that's by far, that's over 90% of what our annual revenue requirement is that we need to collect from our customers. And most of that, or 23 million of that 42 million, is simply the cost of gas. It's what we pay for gas, and we've got to turn around and charge our customers the same amount for that gas. And then beyond that, the other 19 million of that 42 million is all different kinds of expenses, like distribution, O&M, operating and maintenance expense, administrative costs, depreciation, and property taxes. So anyway, that brings us to our total revenue that we try to get in a normal year, which is $46.5 million. But yet our current rates that are in place are only designed to collect $45.5 million, and hence the $1 million that we need. So if this is approved and put into effect, it represents about a 2.3% increase in the overall rate. Next slide. So I said I wanted to talk a little bit about what makes up the 5.52% cost of capital. So just like an individual that buys a home or a business that's financing its assets, Midwest Energy has to use both equity and debt to finance its assets. The the equity portion of it, though, unlike an investor-owned utility, we can't go out and issue stock to raise that equity. And so the only real way we have of generating equity capital is through retained earnings. And so the rates that we have designed contain an element in there to recover a margin so that we can generate some retained earnings. And we hold on to those earnings for about 20 years on average, and then we pay it out as capital credits back to customers. This is different than an investor-owned utility. They also have to charge a cost of equity, but that never comes back to the customers. That is paid out as dividends to their stockholders. And so that's one of the benefits of belonging to a co-op, is that you get those capital credits back to you. Granted, it's after a long period of time, but the plant that we're providing for you has a very long life, and so we've got to match up the capital requirements with the life of the assets as best we can. So if we're paying that out over 20 years, that means that at any time on average we're retiring or paying out 5% of our equity. So just to maintain our balance sheet, we've got to bring back 5% of our equity. So that's part of the return on equity. The cost of equity is that 5% for the 20-year rotation of capital credits. But on top of that, our plant continues to grow. For one thing, materials, supplies are, there's inflation associated with that, but we're also continuing to try to enhance to improve the reliability of our system, and so that costs money. So we estimate that at about 2.5%. So you combine that, the total cost of our equity is 7.5%. But we don't finance our total plant with equity. It's about 41%. So if you multiply that times our cost of equity, there's a weighted cost of equity of about 3%. Then we also have our cost of debt. So the average interest rate that our banks are charging us is about 4.16%. Now, on today's lower interest rate environment, that might not seem too great, but keep in mind, some of these debt issuances have a 30-year life amortization, and so actually, over the life of those loans, that's actually a pretty good interest rate, the 4.16%. And that's about 59% of our total capitalization, and so that comes out weighted at about 2.47. So if you add the cost of equity, the weighted cost of equity, and the weighted cost of debt, that's how you come up with the combined cost of capital of 5.5%. Thank you. And now we'll turn it back over to Bob again.
Thanks, Tom. I'll present information on the proposed changes to rates that Tom discussed in the revenue requirements. There's really three parts to natural gas rates on customers' bills. There's the commodity charge, which is a pass-through cost for customers receiving their bills from Midwest Energy. The second piece is the customer charge, which is a fixed charge that's the same every month. And the third is the Midwest delivery charge, that is a volumetric charge that's billed on a per-therm basis. This slide looks at the proposed changes to the customer's fixed charge. There will be little change to this charge. Some classes are going up slightly and others are decreasing. Residential customers' fixed charge will go from $19.42 to $19 a month, a 42-cent decline. I would also like to point out the oil retail and oil transportation, which have big declines because we're moving those customers to the commercial class, as Pat had mentioned earlier. And he also mentioned there's only about 50 customers in those two groups combined. The customers listed as ag, on ag retail and ag transport, are irrigation and grain dryer accounts. One other item that I would like to point out is that the total change for all classes combined in these fixed charges is that bottom number, the negative $28,296. So on the customer's fixed charges, as all classes combined, we will have a decrease in this portion of the bill of $28,296 on an annual basis. Next slide, please. The proposed delivery rates, all classes in this group on the delivery rates, which is the volumetric charge that we charge to the amount of therms you use in a monthly basis, will have a slight increase in their delivery, except for industrial, retail, and industrial transportation customers, who will see a small decline. Residential customers' delivery rates will go from 13.6 cents a therm to 16 cents a therm. The total annual increase in proposed delivery rates for all classes, that bottom total, will be $1,070,461. If you subtract the total from the slide before on the customer charge, because that was a negative, that was a reduction on the customer charge for all classes, you come up with the $1,042,000 increase that Tom had mentioned as the total increase. Next slide, please. Residential impact proposed with these changes. This would be delivery and the customer charge combined on this impact. An average residential customer on Midwest Energy's system uses almost 700 therms a year, or 58 therms a month. Currently, the bill for that customer on a monthly basis is $27.30. With the proposed changes, the monthly average would now be $28.28, an increase of just under $1 a month. Other examples are shown for customers that use more or less than the average, with customers using 120, which is more than double the average, an increase of $2.48 a month. Next slide, please. The formula rate that we are proposing in this rate change. Currently, Midwest Energy uses the gas infrastructure and the ad valorem, which is a property tax rider, to add annual expenses to our gas rates. We're proposing to incorporate all capital addition and annual expense changes in one annual rate adjustment. This change will eliminate the gas infrastructure and the ad valorem riders, as they will be included in the new formula rate adjustment. This formula rate change will create smaller annual rate adjustments versus larger adjustments when rate cases are done years apart. Therefore, it will create gradual rate transitions. There will be an annual change limit that will be included in the tariff, and the board of directors will review annually prior to implementation. This concludes the gas rate slides. I'll now return the presentation to Pat.
Okay, thanks, Bob. So far we've been talking about the company collecting enough revenue to maintain its financial health, but a very valid question that customers can ask is, well, what are you doing for cost management? And so we've asked Fred Taylor, Vice President of Operations, to review some of those items and how well Midwest Energy stacks up against other gas utilities. Fred?
Thank you, Pat. I'm going to provide some examples of actions Midwest Energy has taken to manage cost, our distribution system improvements that Midwest Energy has made, and results of the system improvements since the last rate change. Midwest Energy's deployed advanced metering infrastructure, which has reduced labor and equipment costs associated with meter reading. And those costs are reduced by over $1 million a year. We reorganized our gas business leadership, which has improved standardization as well as reduced inventory, and that reduced inventory is about $200,000. Midwest Energy has managed our training and healthcare costs, and by the management efforts we've put forward, we're keeping those flat, and they're actually trending a little lower. And when you consider healthcare costs growing at double-digit rates, flat to lower is quite an achievement. Now, Midwest Energy also has managed our fleet costs, and we have quite a large fleet of vehicles. And when compared to inflation, we are reducing costs. And a couple of examples I would give there, if you consider a tire program that we have, the way we buy our tires through fleet program, we're saving about $50,000 a year there. We also are now remounting and refurbishing the service bodies on our equipment numerous times before we replace them. That actually saves us about $100,000 a year just on our service trucks. So quite a bit of effort going in there. We've also deployed technology to the field, and one of the ways that has helped us quite simply is by being able to take electronic maps into the field. And the last time we printed maps, which was about 8 years ago, that print cost us $90,000. So again, the implementation of technology and just keeping our thumb on some of the programs that we have has actually saved quite a bit of money on an annual basis. So at the same time we're managing to reduce our costs in many areas, we're also providing improvements in our system. And since the last rate case, Midwest Energy has removed from service 121 miles of deteriorated steel main. We've also removed 1,452 deteriorated steel services. In that same time frame, we've placed into service 112 miles of new steel or plastic main, and we've installed 1,558 new steel or plastic services. And what that has returned for our customers, when we look at the results of the investments we've made and the employees that we have serving you, Midwest Energy, when we compare to our peer groups, is one of the safest gas distribution systems in the country. And we do that on a periodic basis measuring ourselves against peer groups. But we also actually measure ourselves against the larger utilities in Kansas. And when you look at the 4 largest gas utilities, Midwest Energy has the fewest main leaks, we have the fewest excavation damages, and we have the fewest service leaks. And Midwest Energy has accomplished this while being one of the lowest cost providers of natural gas in Kansas. So, Pat, that concludes what I was going to share, so I'll turn this back to you.
Okay, thank you, Fred. So, yeah, that brings us to the end of our formal presentation. We do have more information posted on our website at mwenergy.com, and regardless of which rate class you might be associated with, you can just go to the residential tab, and there's a link to that. We do have a customer comment period open right now until May 7th. When customer comments come in, as we can, we'll answer those questions, but also the comments will be consolidated and provided to the board of directors before they make their decision. And we've got a couple email addresses there. We will continue to monitor the one we've been using tonight, questions@mwenergy.com. And we also list Bob Muirhead's email and his office number, and you can contact him there. The May 17th Board of Directors meeting will be the portion dealing with what we've discussed tonight will be again open. We're going to do it virtually in the same manner as tonight. We don't have that link ready yet, but by May 7th that will also be posted on our website. So with that, Mike, I'm going to turn it back to you.
Thank you, Pat. And just a reminder, this is kind of the last call for questions from the audience tonight. If you have anything that you'd like to have addressed this evening, please email that to us now at questions@mwenergy.com. We are monitoring that box here in real time. We did have one additional question, Pat. This one came from Ken, and actually he had a comment first. He said, "Thanks for the excellent presentation. I know it's a lot of information that we've put out here tonight, and some of it may be a little bit difficult, to digest if you're not familiar with natural gas or some of the concepts that have been discussed tonight." But anyway, he was complimentary on the presentation and the level of detail that was offered. Pat, Ken's question was, what can be done to protect both customers and utilities from this type of extreme price escalation in the future, if and when there's a similar type of disaster event? Good question.
Yeah, good. Yeah, Ken, thanks for watching tonight. We appreciate that. Well, obviously, we cannot prevent extreme weather, but as all of us have been observing, it seems like in recent years, whether it's cold weather, hurricanes, high wind events, extreme rainfall, as we saw in 2019, these things seem to be happening. All utilities, gas and electric, need to, revisit hardening infrastructure and so on. We see that happening around the country. It's been a very busy time here since mid-February, primarily in assessing this situation and developing a plan. So we haven't done a tremendous amount of work yet on what we do moving forward, but I can mention a couple things specifically that have been brought up. One is we need to take another look at the amount of gas storage we have available. However, on one of the primary pipelines that serve us at this moment, they don't have any additional storage available to sell. And the only way that we could get more storage is if some other utility gives it up. But that we understand that pipeline is contemplating an open season in which they would seek out interest from a large number of players, so they may develop additional storage there. Another matter that has been brought to our attention is, and this isn't on the gas supply side, but it's simply in the ability to communicate with our customers. As you know, with the variety of media these days, the internet, Facebook, social media, a lot of folks, aren't answering their phone. It's difficult to get a hold of our customers quickly and to get them up-to-date information on gas costs, electric service interruptions if those are needed, and so on. And so I think I would like the company to come up with a better text messaging system so that customers can opt into that and receive immediate notice of situations like this. So a lot of things on the drawing board that we can do. But again, we've really been focused on the recovery here, so haven't put a tremendous amount of time in that. I would say that I and a couple others have been here about 40 years. We have never seen anything like this, and it's my understanding that in the power pool's 80-year history, they've never had a situation where they had to ask electric utilities to interrupt load. So a very rare event. And but again, as these weather events seem to be becoming more common, we need to adopt new planning practices to prepare for that.
Thank you, Pat. Okay, looking at the email boxes, we have no additional questions. So with that, I think our presentation for this evening is concluded. Just a reminder that the slides that you saw tonight and this video presentation, the video will be available at Midwest Energy's YouTube channel. So you can simply go to YouTube and type in the search bar Midwest Energy, and our YouTube channel will pop up. We will also link to it via our web page where we're discussing the natural gas rate case, and also the stories on our web page where we discuss Winter Storm Uri events. Again, thank you everyone for joining tonight. We had, I believe at one point, more than 130 folks that were either watching live or were were watching the recorded portion of this evening's presentation. So thank you everyone for joining. If you do continue to have questions in the remaining days, you've seen how to get those in. You can always just simply send us a note at questions@mwenergy.com, and we'll make sure your comments are addressed or noted. Thank you again, everyone. Have a great evening.